Hello everyone, it's the accounting tutor here. Welcome back. It's been a long time since I've seen your lovely faces or imagined what your lovely faces are on screen. This last year has been a bit tough with COVID, but I've seen that a couple of my videos have taken off, especially and surprisingly the one on equity. So I've got a couple of comments in where people want to deep dive a bit more into certain topics on that. And I thought, well, I can't disappoint my fans. But we're going to do things a bit differently. Now, firstly, there's some beautifully edited accounting videos online. I'm not knocking them, but I can't compete in terms of the video editing quality. Right? I don't have time. I'm a finance director. What I can do is give you the accounting theory that I teach staff, that I teach other people, and then the real life applications of those as I see in my day-to-day work. Right? Now, because I can't give you the video editing skills, I'm going to go completely the other direction, and we're going to make this as corny as possible. And as a testament to the beautiful Zoom calls all of us have been having during the pandemic, I am going to run through different types of virtual backgrounds through the rest of my videos. Now, the second thing I thought was, oh wow, you gotta really look beautiful if you want to be successful on online videos. But then I gave up on that because that wasn't really working. So instead, you're gonna get me, currently unbelievably hairy on the beard, haven't cut my hair in a couple of months, and my eyes are so black because of lack of sleep that I'm going to be wearing sunglasses in this video. But I thought we'd dress up for different videos, and hopefully that makes the content more entertaining, which is what I want. I want to make this fun and engaging for people as much as possible. Okay, great. Now that we're done with all of that, let's jump straight into this week's topic. So this video comes at the request of a user called EasyZ, who commented on one of my videos, which I'm very thankful for, and said, "Hi sir, this video is very helpful. I really enjoy and appreciate it. Would you please also share more details on the accounting treatment on share premium under different circumstances?" So EasyZ, that's what you asked for, or EasyZ, that's what you asked for, that's what you're going to get. So let's jump straight into this video then. So today's topic that we're going to cover is share premium. So just as a reminder for all of you, share premium is part of capital and reserves within the balance sheet of a company. Okay, so as a reminder, you have assets, you have liabilities, and then you also have this section called capital and reserve, which is made up of, share capital, share premium, other different types of reserves, and then retained earnings, or in this case, you can see that they're called accumulated losses. Okay, now within that you have share capital, as we noticed. So going back to the previous video that we did on equity, we will go through what the definition there was, but we'll take a deep dive into what share premium is, but also the interactions that it has with different types of transactions from an accounting perspective. So if we take the definition firstly, share premium occurs when shares are issued by a company for an amount greater than the par or the nominal value of the shares. The difference between the par and nominal value of the shares and what was paid is considered the premium that has been paid on the shares, which is called share premium. So let's do an example, because that's quite a lot of words and it probably makes more sense if you understand it. Okay? Now, a company will usually issue ordinary shares to its shareholders. Now, the first caveats to this are you are dealing with companies limited by shares. So this won't apply to companies which are limited by guarantees or things that aren't companies. Okay? We're also going to ignore the existence of preference shares within this. So we're only going to look at ordinary shares and how they kind of firstly interact with the share premium account. A company will issue ordinary shares to its shareholders. And in the UK, any company that is set up and is limited by shares has to issue shares to shareholders, to people that own the company. And actually, you can see that if you go on Companies House and you go to any type of company and you type in their details into the beta site, into the search site, and if you go back just to their incorporation, you'll be able to see their original incorporation documents. And if you click into that, you'll first see the certificate of incorporation. You'll then see the register of companies, the details, the directors. And what you're looking for is the statement of capital. And this will break down all of the shares that the company has. So you can see that when this company was originally set up, it only issued ordinary shares, and it had one ordinary share which it had allotted. And that share was worth £1. So you can see here, statement of capital, currency GBP 1, value 1, number of shares 1. So each share is worth £1. And then you can see that in the next page, what's called the initial shareholding, that is the owner of that share, and it gives you the details of that. Okay, so this is an ordinary share being allotted to the owner. Okay, now ordinary shares can be given to shareholders at any time. It happens obviously on the company setup, but it happens at different stages of the company's existence as well. Now the shareholders will pay for the shares in cash. Some of them leave them outstanding, but normally they'll pay for them in cash. So let's take an example of how this works. Okay, let us say the company has issued 100 ordinary £1 shares. Now the nominal or par value of each share is £1, like we just saw in this example. Now, if the shareholders paid £100 for these shares, what would happen? Well, from the company's perspective, we're giving away £100 worth of shares. So we have to show that as an increase to our share capital. And because share capital is part of capital and reserves, a credit to share capital or a credit to capital and reserves would increase it. So we're going to credit share capital 100. And then we're going to receive cash of 100. Now, receiving cash of 100 is a debit. So we're going to debit cash £100. So that's the only transaction that occurs there. Because we're paying nominal value, we are giving away £100 of share capital and we're getting £100 of cash in return. But now let's change that up a bit. Assume that the shareholders have paid £500 for these shares instead. Well, from the company's perspective, they have given away the same amount of shares, right? They've given away 100 shares which are valued at £1 each. So they're still going to credit their share capital for £100. But instead of getting £100 worth of cash, they're now getting £500 worth of cash. So you're debiting cash 500. So now you've got a difference. Your debit is £400 more than your credit. So you've got to credit something for 400. Well, where does this credit go? This credit now goes to share premium. And if we go back to the definition, we can understand. When shares are issued for an amount greater than the par or nominal value of the shares, then the difference between the amount paid and the total par or nominal value is considered the premium. So The difference between the amount paid, 500, and the total nominal value of the shares, 100, goes to share premium, 400. Now, a question may arise as to, well, this excess, this difference between the amount paid and the value of the shares, why isn't it recognized somewhere else? Why isn't it recognized in a director's liability account? Why isn't it recognized in the P&L as a profit on issuance of shares or in retained earnings? They're valid questions. Well, actually, there's a law for this. Under the Companies Act 2006, Section 610, Part 1, it states that if a company issues shares at a premium, whether for cash or otherwise, a sum equal to the aggregate amount or value of the premiums on those shares must be transferred to an account called the share premium account. So it's quite clear that that's what has to happen, and share premium account is another reserve account. And please remember that share premium is a statutory reserve. This means that it is not distributable. And being non-distributable, it means you cannot, when you assess whether there are enough reserves to pay out a dividend, you cannot include share premium within that distributable reserve calculation. You cannot pay a dividend out of share premium, so it's non-distributable. Okay. However, there are some cases that you can play around with share premium, or not play around. There are some cases where we can do things to share premium and make the amounts distributable. So now we've covered kind of the basics of how we create share premium. Let's now go into the different transactions that make up share premium. I'm sorry that my hands keep disappearing. It's just the way this background's working. All right. Now, what things may affect the share premium account? So firstly, I'm going to bring up a statement of changes in equity of a company. And you'll be able to see some of the things in here as to what's going on within share premium. But I'm going to cover them kind of one by one. The first thing is that expenses or commissions related to share issues that create share premium, those amounts can affect share premium. We'll come back to that. The issuance of bonus shares will affect share premium. The reduction of share premium as part of an overall capital reduction will affect share premium, and the buyback of own shares. Now, the buyback of own shares, because it's quite a complex area, we'll discuss in a separate video, but I will discuss it a little bit. Now, there are, again, caveats to this. There are additional complications that group restructuring, mergers, acquisitions have. All of those will be covered in a different video because they go into very complex areas which most people won't come across unless you work in restructuring or in mergers and acquisitions, or you're going through it yourself, in which case you'll have advisors most likely. But we'll cover some of that. Okay, let's go number one. Expenses or commissions related to share issues that create share premium. So when we issue shares and share premium is created in the issuing company, there are certain companies that may incur expenses or commissions or costs related to that transaction. Now, for most normal companies, this won't be the case because these kind of share issues are minor. Or they're not very complicated. But as you start getting into PLCs or public companies or very, very large corporations with complex allotment of shares, etc., you start getting into the area where there are significant expenses that can be incurred when you do a share issue. Okay? Now, these expenses and commissions must relate to the transaction, the issue of the share, and if they are completely related to the transaction, they can be expensed against the share premium account. So instead of these costs going against the P&L or income statement, which you would normally have, so if you were to incur a cost for professional fees or to brokerage charges, you would stick it to the appropriate place in the P&L, into professional costs and accounting fees or whatever it is in the P&L. It would be an expense in the P&L. Instead of that, the double entry would be to credit cash or credit payables, which you would do in any case, and to debit your share premium. So instead of going debit income statement P&L, you're going debit share premium instead. Now, we've mentioned a few of these costs. Some of them would be, your brokerage charges, professional fees to company secretaries or to auditors, to legal advisors or consultants. If you're using banks, investment banks, then it would be payments to these banks, to underwriter fees, commission fees related to the banks. For some of these public companies, marketing and advertising costs related to the issue of the shares, printing and distribution of prospectuses or application forms or any public material, and then also fees to government bodies for the issue of these shares as well. So all of these costs that are fully related to the transaction of the issuance of the share, they can go against share premium if share premium was created on this transaction. If share premium was not created, they can't go there. All right, number 2, bonus share issues. Now, bonus shares you can go into a lot more detail on. We're going to cover the main parts of it. It isn't complicated, but I think it's worth a few examples, which we'll do in a separate video. But just as a summary for this video, bonus shares are issued by a company as an alternative to issuing a cash dividend to its shareholders, right? So if you own a business or you own shares in a company, you are hoping that at one point either the share price of the company goes up an incredible amount and then you can sell it off for a profit, but more so people are holding these shares so that they get regular payments out of them. So these dividend payments are coming out to the shareholders, and they're a sign that the company is doing well, and that it's generating enough cash flow in order to pay out regularly to its owners. As an alternative to that cash payment, a company can issue bonus shares, and this means that they hold on to their cash and they can utilize their cash for other things. So current shareholders are essentially given free shares, and the shareholders can choose to either keep those shares or they can sell them on, and therefore the shareholders themselves can make profit out of them. Now, these bonus shares are usually dependent on the existing ownership that you have in a company. So a normal bonus share issue would be you get a 1-for-2 bonus issue, which means for every 2 shares that a shareholder owns, they'll receive 1 share as a bonus issue. Now, like I said, the advantage to that is that they're non-cash, but also the other advantages, they can be distributed from any reserves in the company apart from share capital, which means you can utilize share premium to distribute out your bonus shares. Okay, so if we do a quick example, Andy owns 100 shares in Company X, and Company X does a 1-for-2 bonus share issue for their ordinary shareholders, for their £1 ordinary shares. Okay, so this would mean that Andy will get 50 free bonus shares, right? So he has 100 shares. It's one share for every 2 shares you own. So divide that 100 shares by 2, it's 50, so he gets 50 free shares. Now, how do we put this through from the accounting side, right? So one side of the accounting entry has to go to share capital because we've increased our share capital amount, right? There's more shares in issue, even though we haven't got money for it. The amount of shares have increased. And like we did before, in capital and reserves, if we increase an amount there, you have to go credit. Okay, so we're crediting our share capital, and we're crediting it for the value of the share. So it's 50 bonus shares of £1 nominal value each, so that's £50 we're going to increase the share capital by. Now, usually we would get cash, so we would debit our cash. But in this case, we're not. It's a bonus share issue, which means we can debit any other reserve that we want apart from share capital. So in this case, we want to utilize share premium. We will debit share premium for £50. So you will increase your share capital and you will decrease your share premium by the same amount. And that's how bonus shares work. Now, you get complications in bonus shares, and we will cover that in another video where we'll do lots of different examples. But that's another way of utilizing your share premium account. Okay, number 3. The reduction of share premium as part of a capital reduction. Now, for me, this is one of the most common transactions that I have seen recently in the work that I've been doing. And my work has focused on group restructures, on certain mergers and acquisitions, and settling certain intercompany balances. And one of the ways that we create distributable reserves is through the reduction of share premium. So this gets quite common in those types of transactions. So I'll explain how it works. So as part of the Statutory Instruments 2008, number 1915, you don't need to go into this detail, but it's part of the company's reduction of share capital order 2008. A company can decide to reduce all or any amount of its share premium and reallocate the amount to any other reserve except for share capital, or to a new reserve when no reserve exists, or if no reserve is selected, it goes to retained earnings. So to repeat that, a company can decide to reduce all or any of its share premium and reallocate it to another reserve except share capital within capital and reserves. Now, why is this so important? It's so important because this allows non-distributable reserves, which share premium is, to all of a sudden become distributable as part of a dividend. So no capital reduction has to take place. And a capital reduction is a decrease in the value of your normal share capital. So what it's saying is that doesn't need to happen. A reduction of share premium, can be the only part of your overall capital reduction, right? It can be the only part of what you're doing. So what does this mean? How does this work from an accounting perspective? Let's say you have £10,000 in your share premium, right? And your retained earnings is actually accumulated losses of 5,000. And you want to be able to pay a dividend out of 5,000. Then how can you do that? Well, now, using this statutory instrument and using the set of steps that we have to go through, which we'll come to in a second, we will debit our share premium for the 10,000, right? We're going to debit it for the 10,000. That releases the 10,000. We're going to credit our retained earnings for the 10,000, which increases it by the 10,000. Yeah, that takes our share premium down to 0, increases our retained earnings, and all of a sudden we have enough to pay out that dividend. Now, there are certain things that you have to go through, steps you have to go through for this to be allowed. So all directors have to sign a solvency statement. Shareholders must approve the capital reduction via special resolution with 75% of votes within 15 days of the solvency statement, and a special resolution has to be filed with Companies House within 15 days, right? But it's usually administrative, right? That happening, and yeah, so that's also the other way to decrease or to affect your share premium. Right, so we've covered 3 different ways in which share premium can be affected. Obviously, there are other ways which we spoke about, such as the buyback of own shares and certain interactions with group restructuring and mergers. But hopefully that gives you some idea of the different ways and the different movements within share premium itself. I want to thank you for watching this video. Please share it. Please subscribe to the channel. Please comment on the videos. If there's anything else that you would like me to focus on, I'm happy to go ahead and make videos on that. So please do comment and tell me what you want me to do. And if you could, please go and have a look at my Instagram, which is going to come up here. And I will be posting more content this year, I promise. But thank you very much for coming, and have a wonderful day. Take care. Bye.